The debt ceiling coming to a negotiational agreement is a mask. It's the financial crisis is still here. It's still around the corner. We haven't entered it officially yet, but I'll tell you what, you ask yourself, are you feeling the financial crisis? Because I guarantee you probably are, and it's only gonna get worse. This whole hoopla about, the corporate bureaucracy has come to the agreement and consensus, and they're gonna, have $2 trillion per year up to 2025, increasing it by $4 trillion. That brings our national debt from $32 trillion today to $36 trillion by 2025, even though that might give some time for, the elections to happen in 2024. Guess what? We're still holding the bag, the people, because that $4 trillion, it is mainly going to banks and corporates. That's not you and me. There's a banking crisis that will only get worse. It's not gotten better. Yes, it's a little bit quiet, but guess what? Come June 14th, before the market started to say, hey, we only have 25% chance that we'll increase it, now it's to 60. I've been saying that. It's going to increase because we heard Jerome Powell say that he's planning on increasing it already. The financial crisis is still here. The 2 quarters haven't come around yet, but the debt to GDP is still at abnormally high levels. The banking crisis is only getting worse. And so we're going to get into all this and a little bit more. You've reached here at Financial Almanac. I'm Paso, and let's have a look on how ugly things will get. What the mainstream media isn't sharing with you when they offer you their Frankenstein Kool-Aid is that US bankruptcies for corporations are at a high. They haven't been this high in over a decade, meaning corporations are going to bankruptcy court more than ever. This is ridiculous. As the financial markets are not doing too well, it's getting harder for borrowers to make ends meet. We're seeing that the office towers are becoming vacant and regional banks are having to struggle to have some sort of earnings in their profits. And if not, guess what? People are going to continue to have their bank walk / aka bank run to withdraw their deposits and continue to put those in those treasuries because the financial markets are very risky right now. We're seeing that the treasury rates for short-term, 3 months and 1 month are peak highs. This is ridiculous, meaning there's more risk in the near than there is in the distant future. How ridiculous is this? And they want to play off like the financial crisis isn't here. Ladies and gentlemen, if you haven't been watching the alternative news media and just only been watching mainstream media with their Frankenstein Kool-Aid, we're in the middle of a crisis. I'm sure you feel it. When you go to the gasoline, are you paying more than you have in forever? Are you not paying more for food that you're accustomed to? And they're saying that, there's so much money sloshing around and blah, blah, blah. Guess what? Corporations are going bankrupt more than they have in the last 10 years. This is ridiculous. The borrowing rates are getting squeezed and a lot of companies can't manage those rates, especially if in June 14th, Federal Reserve, as I've predicted in my previous videos, will continue to increase their rates. The markets are finally coming around. Before they were saying, there's only a 25% chance that the Federal Reserve funds rate will increase to 50. We've seen what happened when Jerome Powell was talking to that deep fake pretending to be Zelensky, the president of Ukraine, that he said, hey, we're gonna raise again. So why wouldn't I not believe him? He has to fight inflation. We're at 5%. That's more than double than his target of 2% inflation. And that's after all the magic wanding that he's did to change the algorithm for how they calculate the CPI. And it's still at 5%. Yes, it might slowly come down, but guess what? It's still very high. More large US companies are taking shelter in bankruptcy court. A sign of a tightening credit squeeze as interest rates rise and financial markets become less hospitable to borrowers. Our house of cards of financial system is based on debt that has never been paid down. It's still increasing. We're approaching $32 trillion. Our debt to GDP level is at 120%. Historically speaking, no empire, no country recovers from this. It's been the US, policy for a while now is to keep printing debt, and we haven't paid it off, ladies and gentlemen. And it trickles down from top to bottom, and that's why people have been living paycheck to paycheck, but now people are paying living credit card to credit card. It got so ridiculous. So you're asking yourself, how can I make ends meet if I don't borrow? Well, ladies and gentlemen, if the credit tightening does happen in June 14th, this will contract the liquidity, the cash availability in the market, and you have to prepare yourself for this coming disaster that is literally around the corner. It's in a few months away. We're seeing companies go to court for bankruptcy, and things are only getting worse. As reported by Financial Times, 8 companies with more than $500 million in liabilities have filed for Chapter 11 bankruptcy just this month in May, including 5 in a single 24-hour stretch last week. In 2022, the monthly average was just over 3 filings. Ladies and gentlemen, this is ridiculous. And people are saying there's no financial crisis. Where are you looking? 27 large debtors have filed for bankruptcy so far in 2023, compared to 40 for all of 2022. According to figures compiled by bankruptcydata.com. Among recent companies to succumb to creditors including Envision Healthcare, Vice Media, Kitty Fenwal, a maker of fire control system facing thousands of lawsuits over its use of so-called forever chemicals. Ladies and gentlemen, we're seeing companies go bankrupt. When it comes to retail stores, there's been an alarming amount of store closures that has been sweeping the nation. As of just 2022, just for that year, there's been over 10,000 retail stores closed. And during COVID, retail stores had to borrow money just to keep their businesses alive, even though some of them had to force close, but still had to pay property tax and insurance and utilities. These are coming out of their pocket. They're bleeding, hoping one day they would reopen. And when they did reopen, guess what? There wasn't enough to keep them going, so they had to close in 2022. Yes, we saw that transition go from brick and mortar to digital, okay? We see that. But guess what we also saw during that transition? Inflation. That's when everything was, a limited supply because of supply chain issues and everything on Amazon and whatnot. The e-retailers were competing for the same products. And now we got out of that, the market's opened again, but there wasn't a lot of supply and demand anymore as there once was before COVID-19. The global situation has completely changed. It got so bad that even wealthy families were going to shop at Walmart. A once absurd idea. We saw staple retailers get shaken like Bed Bath & Beyond. They're about to close by the end of this year, so many stores. Best Buy has already cut 5,000 jobs. And as of 2021, they've closed down 60 stores. This year, they have announced already, as of 2023, that they're planning on closing 20 more stores come the second half of this year. But this isn't just Best Buy, this is across the board. This crunch is affecting all classes, essentially. We're seeing closures from CVS, Dollarama, Dollar Tree, Dollar General, all the dollar stores we're thinking of, Tuesday Morning, Party City, Rite Aid. These are all being affected and they're closing down. Ladies and gentlemen, we are in a financial crisis. We're seeing small businesses, mid-tier businesses, and even large businesses shut their doors down due to less foot traffic, more people buying online. But not only that, they're not even able to keep up with keeping staff online. They have to let go of so many staffs, even the ones that do remain open. I don't have to tell you things are bad, but things are gonna get worse, much worse. The Financial Times says that the bankruptcies come after years of quiescent market and raising valuations, allowed even financially stressed firms to raise debt and equity capital to stay afloat. Debt default rates have fallen to about 1% in 2021 as central banks pumped money into the coronavirus pandemic stressed economy. That basically means that businesses that needed support during the 2021 crisis that the world has experienced could go to the bank and borrow at a very low rate, large amounts of money as a gas mask to make the businesses survive. But after all of that, today banks are having their crisis, so they need those gas masks back. And guess what that does for the businesses? It euthanizes them. Now the S&P Global forecast at the 12-month trailing default rate for speculative grade securities will jump from the current 2.5% to 4.5% by early 2024. The Financial Times also says yields on junk bonds have more than doubled from less than 4% in mid-2021 as measured by the Bank of America US High Yield Index, an indication of how much more expensive capital has become for less credit-worthy borrowers. The Federal Reserve has warned that lenders could further contract the supply of credit to businesses after recent turmoil in the banking sector. Ladies and gentlemen, the debt ceiling thing is just going to try to support a few sectors. I'm going to get into the debt ceiling, what those terms mean and what they covered, and now what that essentially does for the economy. Companies were using every trick in the book, whether it was GAAP or non-GAAP accounting. This is ridiculous. We're seeing so many businesses fall that they have been during the crisis. We're seeing more bankruptcies than there has been in the last 2 years. We're seeing in this quarter, there's so many bankruptcies, more than there recently was. As we see banks put on their gas mask, effectively euthanizing businesses, we see that the Federal Reserve is essentially pumping billions of dollars to keep these banks afloat. So the banks are trying to tell you everything is fine. The mainstream media is telling you everything's fine. If you drink their Kool-Aid or their Frankenstein Kool-Aid, you wouldn't know this. This is shadow banking. Here we are at the Federal Reserve economic data. We are looking at bank term funding programs. That's under assets, liquidity, and credit facilities. Ladies and gentlemen, during the recession of 2008 and 2009, we don't see any credit facilities being lent to the banks. There was no banking crisis. During COVID, no banking crisis. Over here, things get really hot. Let me zoom in for us so we have a closer look. Ladies and gentlemen, as of March 8th, when everything changed, the week after. Okay, this is during Silicon Valley Bank when they were being bailed out. Look at this. It starts to have a record. It keeps going up. It keeps going up all the way till today. Nearly $92 billion to these guys, to the shadow banking system, and they're telling you the banks are okay. This is liquidity being directed directly to them under loan structures, and they're saying everything is okay. They're just giving them capital while they're increasing the debt ceiling, and then what's going to happen is it's going to trickle down years later to us, giving us crumbs using Social Security, which they've already promised us, right? Because we paid into it, but they bankrupted that system, and here we are increasing the debt ceiling yet again so these banks can be bailed out, because this is actually a banking crisis. Of course, they're not going to tell you there's a financial crisis. Of course, they're going to say, oh no, we're not bailing out these banks. They're going to say, hey, have you been watching mainstream media? Have you had your daily dose of Frankenstein Kool-Aid? Because it seems like you're thinking for yourself. So yes, we are in the middle of a financial crisis, and it's only going to get worse. The fact that you're watching this, you're trying to invest in yourself by saving and protecting your assets, or if you're trying to learn how to critically think and grow with your community and working together to mitigate the amount of negative effects that this recession coming up will affect you. So I want to give you a like. Just let me know where I can go to give you a like, because you're doing an amazing job by investing in yourself. But a lot of most Americans don't know this stuff, and that's the people that need the most help. Most Americans don't know that these conservative banks that we were led to believe in are not taking risky bets, but they have. They've been doing the most speculative bets and lost almost 50%, but they haven't sold yet. They're in negative profits, but it's not real yet because they haven't sold. If me and you had that and we sold, guess what happens? We lose that money. But when banks do it, they get bailed out by the Federal Reserve, and that's what's happening. They're going to the Federal Reserve and saying, hey, we have 50% losses on a lot of these speculative bets that we did, so can you bail us out? They said, no problem. Here, we're gonna market to market when you entered, meaning they're just gonna negate all your losses if they had sold. This is the worst time to do it, because who's paying for that? Me and you. And that's what the debt ceiling does. It's taking away from sectors that need it, except for the IRS people. There should have been more, but I'll get into that later in the video. And they're actually putting it into banks and big companies that are too big to fail. And it's not just too big to fail, it's also the medium-sized banks to prevent a bank run. If people start thinking, hey, my deposits aren't safe because these guys are collapsing, the FDIC only has a certain amount of cash to save a certain amount of banks. There's over 4,000 banks. How are they? They're nowhere close to save all those people. So, as I said in my previous videos, this is going to be a Hunger Games event between all these banks. They have plans regarding rolling out bank CBDCs on the Fed Now payment system. There's 2 videos before this that help sort of complete that picture. But there's going to be last bank standing, and that's what they want. They're okay with that because they think there's just too much opportunity in the system, and some of that opportunity has to go save the federal government and the big banks. Ladies and gentlemen, this is another very important chart I want to share with you guys. This is the discount window borrowing for the banks, it reached an all-time high. We see that the bank's use of federal backstops surpassed 2008 crisis levels. Back in 2008 and 2009, we reached a peak of $110 billion being borrowed by the banks. Over here, we see that $50 billion was backstopped by the Federal Reserve, which increased we broke those records to 150. We broke the records of 2008 and 9 and 2000 and 2021 to ridiculously absurd levels. The banks are going to be receiving trillions of dollars because of this debt ceiling negotiation consensus that they're putting together. You know, the congressional U.S. military industrial complex is going to be receiving millions of dollars to save Ukraine, to save Israel, all of this stuff. It's just all BS. Why are we paying for it? We're basically getting the crumbs. They're gonna get trillions of dollars, and by the time it trickles down to us, we're gonna have so little money that still our veterans are gonna suffer. It's gonna be still increasing in homeless people. It's gonna be so bad for the masses. And if you think you're immune, saying, hey, that's not gonna affect me, you're gonna be paying with it. Taxes will be increased. You know, Congress did ask Janet Yellen about the Reduction Act that the Biden administration has pushed, and well, here's the video.
Isn't it a fact that the president's proposed budget proposes $4.7 trillion in new taxes?
It does propose significant additional taxes, yes.
4.7 trillion?
Something like that, yes.
Okay. You talked about reducing deficit. Isn't it a fact that under President Biden's proposed budget, that gross debt will rise from $32.7 trillion at the close of this year to $51 trillion by 2033? Isn't that a fact?
That's probably a fact.
So you haven't reduced the deficit, have you?
The deficit, the debt and deficits are reduced by the president's budget.
How can you go from $33 trillion to $51 trillion and call that a reduction in the deficit?
So yeah, taxes will go up. Not only that, they will continue to print money effectively, not only increasing the money supply, but it's a hidden tax to us, the people. If they print $2 trillion, they debase the value that we have in our accounts. Hence, it's a hidden tax. So there's the, obvious tax. There's the objective tax, and then there's the subjective tax, the hidden tax, inflation, just printing up money, the $2 trillion over the next 2 years, $4 trillion by the time 2025. It'll be so bad for us that it's only going to get worse, and we have to make sure we have our mindset prepared for this, and that's why you're watching this, and you need to share this with people that have no idea this is about to come. I don't want you guys to be fooled by this debt ceiling deal, okay? What will happen is there'll be $4 trillion from now till 2025, essentially meaning that there won't be a political situation when it comes to the debt ceiling for the next 2 years. They will be increasing the debt ceiling by $4 trillion. As I mentioned before, we go from $32 trillion to $36 trillion. Discretionary spending will be capped for these 2 years. For this year and next year, the same time next year, it'll be 0% rate, but then the year from this time next year to 2025, it'll be increased discretionary spending by 1%. That basically means for discretionary domestic programs, there won't be no increases except for, Social Security, Medicaid, things that we already have obligations to, but nothing in addition to that. And the following year after that, there'll only be a 1% increase in that discretionary spending. When it comes to climate change section of the debt ceiling deal, Republicans want to take away hundreds of billions of dollars in clean energy infrastructure and investments, but the Democrats won. The Republicans were only able to, amend some permit regulations as well. Away from that, going into the IRS section of the deal, IRS initially, because of the Income Reduction Act, were given $80 billion for the IRS to hire new workers. Initially, the Republicans wanted to reduce that by $70 billion, only leaving them roughly $10 billion to the IRS, but the other way took effect, where essentially the deal takes place now. They have $70 billion and only $10 billion was able to be retrieved, and that might actually change, might even get lower after it reaches the House and the Senate. The government will be receiving unspent money regarding the COVID programs. That money was supposed to continue to rebuild the healthcare system, but that will be removed now. Regarding student loan forgiveness program, we're waiting on the Supreme Court to make their rulings regarding the student loan cancellation. But as of right now, the debt will have to be paid starting very soon, and so that'll put a lot of pressure on students. We expect to see a lot of defaults and delinquencies from that, and we don't know how the Supreme Court will rule, but it's not looking favorable. We're not only seeing this with student payment freezes being affected, we're also seeing this regarding work requirements for the SNAP program. The SNAP program has to do with food stamps. Now today, if you're 49, able-bodied, and have zero dependents, you know, upon certain working conditions, you can qualify for food stamps. Those restrictions are going to be even tighter now for a majority more people. Now it's taking it from 49 to 54, where it's going to be tighter restrictions if you have no dependents and are able to work. We're seeing a win for Democrats because there was no work requirements for recipients of Medicaid, and they increased the food benefits for homeless and veterans as well. Now we still have to wait for this week or maybe even next week on to see if the House of Reps will be passing this, which will lead it to the Senate to be passed. And if it does pass, this will be the 79th time the debt ceiling was raised since its first raise in 1914. Coincidence that the year before that the Federal Reserve was born and the Security Exchange Commission was born. Let me know if you see a pattern down below in the comments. But yeah, ever since 1913 with the Federal Reserve Act and 1913 with the Security Exchange Act, Woodrow Wilson did say he was disappointed. If you saw my last video, you know exactly what I'm talking about. So 79 times the debt ceiling for the nation has been raised, and we're at 32. This will bring it to 36 for the next 2 years, and it's mainly going to bankers, and small businesses will continue to, you know, struggle, and office towers are being vacant and they're going back on the market. Yeah, it's not looking good. The recession is definitely around the corner. Ladies and gentlemen, if you have invested in AI, if you have invested in anything that has in the green right now, please take some profits. You know, dollar cost average out as the prices increase. That way you have some liquidity when we re-enter the market. If you are in a loss right now, I'm sorry to hear that, and there's nothing we can do. If you haven't invested yet and you're looking to what to do, put some money together. Start, you know, putting it into short-term treasuries. That way you can have a yield, and as the market corrects, we can re-enter in the market once it falls. I expect that to fall by December, about 20 to 30% from where we are. That's what I'm planning on doing. I'm not your financial advisor, but do consider having some cash on hand to re-enter the market if that is your sector. I'm of the belief that the financial crisis is really very much here, if not at our doorstep, even though officially the recession hasn't happened, because, you know, the Fed don't think that, you know, we have 2 quarters of negative GDP and the unemployment rate isn't as high as they want. We very much feel the effects of inflation, whether it's at the gas pump or whether we're trying to fill our fridge up with groceries. I feel like it's here, and I'm sure you do too. If you haven't had any cash, make sure to find ways to be productive for your community, to help with one another, and start to, you know, find a hobby that will generate a little bit of cash here and there. That way when the market does correct, which I expect by December, I do expect the market to draw down an additional 20% because things are very lofty right now. We have, if you look at the S&P 500 and look at the top 5 and compare that to the remaining 495, we see Meta, Apple, Amazon, Nvidia now, and Google are carrying the market, while the 495 remaining in the S&P isn't looking too good. It looks very bloody, and I do think that's only going to get worse as funding in those 5 big ones will start to retract and correct a little bit, and people will be doing tax loss harvesting later on this year before December. So there will be a huge drawdown. We will be breaking a lot of support that we see on technical analysis charts, which I find to be very gruesome. So I do expect 20%, you know, minimum 20% correction in our market. So make sure to have some cash, find a way to put some cash together so when the markets do drop, you're able to enter that correction. I do find that also during the presidential election of 2024, the current party, the Democrats, will be supporting the stock market as history has shown. It'll be a great time to re-enter once this correction has happened, to ride the wave during the presidential election, and we'll see how we'll go from there. So I do expect a recession coming up. I do believe it'll be short-lived because of quantitative easing. I'm still of the belief that in June 14th, the Federal Reserve and Jerome Powell will be increasing it by 25 basis points, bringing us to a total of 5.5 federal funds rate. And after that event, come July, I think they'll start pausing. And then from there, events will take place in August where we'll start to correct. The summer euphoria has waned away. Autumn or fall will start to come into effect, and that will basically bring down our market for that quarter. Maybe another quarter, GDP will officially be in a recession. And then before the election of 2024 for the president, we'll have a market start to rebound, quantitative easing, lending. A lot of collapses would happen by then. A lot of bank mergers and acquisitions would happen by then. So make sure you have some cheddar, you have some cash ready to reinvest into the market if you take some profits, dollar cost out, and as the market corrects, we can dollar cost in again, okay? Slowly, not by lump sum amounts. Ladies and gentlemen, I want to give you guys a like for being such investors in yourself. Our mindset is very important to invest in yourself. So I want to say thank you for helping yourself and helping others in our community, in the financial sector, and in the health, wellness, mental aspect of our sector as we go through these turmoil, turbulent times. And if you've made it this far, I want to ask you to subscribe if you haven't yet. And Basil, thank you for watching the Financial Almanac. I'll see you guys in the next video. Peace.